So here's a question. Can a stock be a screaming bargain? I mean, really cheap, but still be a terrible investment? For Bristol-Myers Squibb, ticker BMY, our research suggests, well, this might just be the case. Looks like a potential value trap. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today we're diving deep into BMY. We're using data pulled just this morning, September 29th, 2025. And our goal, our mission really, is to unpack these really conflicting signals around this pharma giant. It feels like every positive is canceled out by something negative.
Yeah, and maybe starting with the bigger picture, the macro scene. Futures are up a bit this morning, sort of a risk-on mood. It seems fueled by some pretty resilient U.S. economic data that came out, but here's the twist, right? That same economic strength that's making investors feel good today, that might actually push back any Fed rate cuts. So yeah, there's optimism, but it feels a bit fragile on a short leash, as you said.
Okay, right. So let's zero in on BMY then. Starting with the bargain side of things from our research. I mean, look, on the surface, the fundamentals seem incredibly strong. This isn't some small company. They've got massive blockbuster drugs, Liquick, Opdivo, you know the names. Plus, they just announced positive trial results for a new cancer drug. And they're expanding patient discount programs. All good stuff, theoretically.
And the valuation gap, it's just staggering. We ran one free cash flow model, just one perspective, mind you, but it suggests a fair value over $97 a share. Meanwhile, the stock's trading, around $44?
Around $44, yeah.
That's an enormous discount. It screams fear in the market. But this is exactly where those value trap alarm bells start ringing, you know?
Exactly. If it's really worth almost $100, why does management seem to be, tightening the belt? And why are the big institutions apparently selling? That disconnect it's pretty concerning. The market's clearly spooked. There was that strategic review announcement, okay, maybe not unusual, but then crucially, a $300 million cut in R&D spending.
And that R&D cut, host speaker, that's really the heart of the problem here. In biopharma, R&D isn't just like optional spending. It is the future revenue. It's the pipeline, cutting $300 million. It signals management might be prioritizing short-term cash, maybe cleaning up the balance sheet, I don't know. But it feels like they're mortgaging the future to do it. And that probably explains why, 19 out of 26 Wall Street analysts are just sitting on the sidelines, rating it a hold. They don't know what to make of it either.
Right, they're waiting. But that's why we can't just look at the analysts, because while they wait, the actual money, the traders in the options market, they seem to be telling a totally different story.
Exactly right. Sentiment, if you look at the options market, actually tilts bullish. We looked at the put-call ratio. It's low, currently sitting at 0.57. A ratio under 1 like that, especially down there, it's significant. It means traders are betting almost twice as much on the stock going up calls versus going down puts. That's pretty strong vote of confidence, at least from the short-term crowd. And the pros who bet on declines, the short sellers, they're barely there. Tiny short interest, like 1.45%. So no real conviction of a collapse among traders.
Okay, but then you clash that options optimism against the charts, the hard technicals. And the picture there is, it's undeniably bearish. It just looks bad. Long-term trends, short-term trends, both pointing sharply down. And the volume patterns seem to confirm institutional distribution. That's the big money, right?
Institutional distribution, yeah. That means the large funds, pension funds, mutual funds, they appear to be consistently selling. That signals a pretty deep loss of faith in the long-term story for BMY. But, it raises a question. How fast can something fall before it just pauses? The selling has been so intense, the drop so fast, that BMY is now technically oversold, which just suggests the move down might have been too quick. A short-term bounce, or relief rally, entirely possible, though underlying volatility is still pretty contained, so maybe it's just waiting for some kind of tactical trigger.
Okay, so we've sifted through all this conflicting stuff in our research. Deep value versus deep fear. What's the final call? Where do we land? Our take is neutral, but with a bearish bias.
Yeah, neutral with a bearish bias. And that bias comes down to three main risks that, frankly, overshadow that potential $97 valuation for now. 1, the overwhelmingly negative long-term technical trend, big money leaving. 2, that major R&D cut we talked about, it just puts a question mark over the future pipeline. And 3, the fact that most Wall Street analysts are just saying wait and see. They won't stick their necks out to buy it.
So for you, the listener, if you're watching BMY, the immediate battleground seems really tight. It's between about $43.50 and $44.50. That's the zone. If the bulls can't hold that range, well, the invalidation level, the point where things look really bad again, is probably a sustained close below $43.25. Below that, it signals a downtrend is likely back in charge, and trying to touch that knife could be pretty painful. So BMY, massive value play, or a falling knife. Right now, it kind of looks like a knife that just hit the floor. Maybe it bounces a little, but you need extreme caution, real precision if you were thinking about trying to catch it. That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.